In September 1985, 5 men gathered in a luxury suite at the Plaza Hotel in New York City and made a decision that would alter the course of global economics for decades to come. The finance ministers and central bank governors of the United States, Japan, West Germany, France, and the United Kingdom signed an agreement that day, a document barely a few pages long that most Americans have never heard of. Yet this single meeting would trigger the greatest financial bubble in modern history, destroy Japan's seemingly unstoppable economic rise, and create economic consequences that Japan still struggles with 40 years later. This is the story of the Plaza Accord, the day America weaponized currency to save itself and accidentally condemned its biggest rival to decades of stagnation. To understand why this meeting happened, you need to go back to the early 1980s when America was facing an economic crisis that terrified policymakers. The US dollar had become absurdly strong, rising over 60% between 1980 and 1985. Now you might think a strong dollar is good, and normally it can be, but this was different. American manufacturers were being annihilated. A strong dollar meant American products were expensive overseas, while foreign goods, especially from Japan, were incredibly cheap in America. Japan was crushing American companies in cars, electronics, steel, and machine tools. Toyota and Honda were taking over Detroit. Sony was dominating RCA. American factories were closing and entire industrial towns were dying. The Rust Belt was forming before everyone's eyes. The US trade deficit with Japan had exploded to over $50 billion annually, an astronomical figure for that era. American workers were losing jobs by the hundreds of thousands, and politically, something had to be done. Congress was threatening massive tariffs and protectionist legislation that could have started a global trade war. President Reagan's administration needed a solution, and they needed it fast. Japan, meanwhile, was experiencing what seemed like an economic miracle. Throughout the 1970s and early 1980s, Japanese companies had perfected a strategy of manufacturing high-quality products at competitive prices and flooding American markets. The yen was deliberately kept weak, which made Japanese exports even more attractive. Japanese workers were productive, their companies were investing heavily in new technology, and their products were genuinely better than American alternatives. Toyota cars didn't break down like American cars did. Sony televisions had better picture quality. Japanese companies were buying American businesses and real estate. There was genuine fear in America that Japan would become the world's dominant economic superpower. Books were published with titles predicting Japan as number one. American business schools were teaching Japanese management techniques. The future seemed to belong to Japan, and many Americans felt their country was in irreversible decline. The Reagan administration, led by Treasury Secretary James Baker, came up with a plan. Instead of imposing tariffs or trade barriers, which would be messy and could backfire, they would force a currency realignment. If they could make the yen more expensive relative to the dollar, Japanese exports would become more costly. American exports would become cheaper, and the trade imbalance would correct itself. It was elegant in theory. The problem was that currency markets are massive and difficult to control. No single country, not even the United States, could simply decree that exchange rates should change. They needed coordination. This is where the Plaza Accord comes in. Baker orchestrated secret negotiations with the other major economic powers, convincing them that coordinated intervention in currency markets could rebalance global trade. For Japan, this was presented as necessary to avoid American protectionism. For Germany, France, and Britain, there were benefits in seeing their currencies rise against the dollar as well. The meeting was kept secret until the very end, because if currency speculators knew what was coming, they could have positioned themselves to make billions while undermining the intervention. On September 22, 1985, the announcement was made. The 5 nations agreed to jointly intervene in currency markets to bring down the value of the dollar. This wasn't a suggestion or a hope. This was a commitment backed by the world's largest economies acting in unison. The impact was immediate and dramatic. Within weeks, the dollar began falling rapidly against the yen and other currencies. By the end of 1985, the yen had appreciated roughly 20% against the dollar. But that was just the beginning. Over the next 2 years, the yen would double in value. A dollar that bought 240 yen before the Plaza Accord would buy only 120 yen by 1988. This was an absolutely massive shift happening in an incredibly short period. For Japanese exporters, this was catastrophic. A Toyota that cost them the same amount of yen to manufacture now cost American buyers almost twice as many dollars. Japanese companies were suddenly uncompetitive overnight through no fault of their own. The Japanese government panicked. Their entire economic model was based on exports, and now their export sector was being crushed. Corporate profits collapsed. Companies started laying off workers. The stock market wavered. Japan's Ministry of Finance and the Bank of Japan made a fateful decision. To prevent a deep recession, they would stimulate the domestic economy by slashing interest rates to historic lows and flooding the economy with cheap money. Interest rates fell from over 5% to below 3% and kept dropping. The government encouraged banks to lend aggressively. The idea was simple. If Japanese companies couldn't sell products overseas anymore, they would shift to serving domestic demand instead. Stimulate domestic consumption and investment, build more infrastructure, get people spending. This seems reasonable until you understand what happened next. With interest rates so low and money so cheap, a feeding frenzy began. Japanese companies and individuals started borrowing massive amounts to invest in real estate and stocks. The thinking was straightforward. Why keep money in a bank account earning almost nothing when you could buy property or stocks that were going up? And they were going up fast. Tokyo real estate prices began doubling, then tripling. The land beneath the Imperial Palace in Tokyo was famously valued at more than all the real estate in California combined. A single square meter of choice property in Tokyo's Ginza district cost more than an entire house in most American cities. Corporations borrowed money not to build factories or develop new products, but to speculate on real estate. Banks, awash with deposits and desperate to lend, stopped caring about whether borrowers could actually repay loans. They started accepting real estate as collateral, and since real estate prices only went up, it seemed like a safe bet. This created a vicious cycle. Banks lent money for real estate purchases, which drove up real estate prices, which meant banks could lend even more money, using the inflated property values as collateral. The stock market went even crazier. The Nikkei index, which measures Japanese stocks, went vertical. It rose from around 13,000 points in 1985 to nearly 39,000 points by December 1989. That's a tripling of the stock market in less than 5 years. Everyone was making money, or at least it seemed that way. Housewives were day trading stocks. Taxi drivers were giving stock tips. Japanese businessmen were buying impressionist paintings for tens of millions of dollars. $4 billion. $4 billion. A Japanese investor paid $82 million for Van Gogh's portrait of Dr. Gachet. The Japanese economy had become completely unhinged from reality, but it felt real because everyone was getting rich, at least on paper. The government and central bank saw what was happening, but convinced themselves it was fine. Some called it a new economic paradigm. Japan had transcended the normal boom-bust cycle. Their superior management and cultural discipline meant they could sustain higher valuations. It was the same kind of dangerous thinking that precedes every bubble in history. Then reality arrived. By 1989, even the Bank of Japan recognized they had created a monster. Inflation was starting to pick up as all this borrowed money chased a limited supply of goods and assets. They decided they had to cool things down. In May 1989, they started raising interest rates, 5% back up to 6%. Credit that had been nearly free suddenly became expensive. Companies and individuals who had borrowed vast sums to speculate on real estate and stocks suddenly faced much higher interest payments. The stock market peaked on December 29, 1989, at 38,915 points, and then it started falling. At first, it seemed like a normal correction, but it kept falling, and falling, and falling. By October 1990, the Nikkei had lost nearly half its value. Real estate prices followed. The collateral backing all those bank loans was evaporating. A property that a bank had valued at $100 million when they made a loan was now worth $50 million, but the borrower still owed the full amount. Banks suddenly realized they had made trillions of yen in loans that would never be repaid. Borrowers couldn't pay, but they also couldn't sell the assets because nobody was buying in a crashing market. The Japanese banking system was drowning in bad debt. What followed was 2 decades that Japanese economists now call the lost decades. The stock market never recovered. As of today, over 35 years later, the Nikkei has still not returned to its 1989 peak when adjusted for dividends and inflation in real terms. Real estate prices fell by up to 80% in some areas and stayed down. Companies that had borrowed heavily went bankrupt. Those that survived stopped investing and hiring. They focused obsessively on paying down debt. Banks, saddled with bad loans, stopped lending even to good borrowers. This created a credit crunch that strangled the economy. Even when the Bank of Japan cut interest rates back to near zero, it didn't help because banks wouldn't lend and companies didn't want to borrow. They had learned their lesson too well. The Japanese government tried everything: massive infrastructure spending, tax cuts, bailouts for banks, even unconventional monetary policies like quantitative easing years before the Federal Reserve tried it. Nothing worked. The economy barely grew for 20 years. A generation of young Japanese entered a job market with no opportunities. Lifetime employment, the cornerstone of Japanese corporate culture, vanished. Deflation set in, meaning prices actually fell year after year, which sounds good until you realize it destroys economic incentives. Why buy today when it will be cheaper tomorrow? Why invest when you won't make a return? The human cost was staggering. Salaries stagnated or fell, young people couldn't find stable jobs and gave up on marriage and children because they couldn't afford families. Japan's birth rate collapsed. Suicide rates spiked. The psychological impact of going from feeling like an unstoppable economic superpower to stagnation and decline cannot be overstated. The confidence and optimism of the 1980s curdled into resignation. Meanwhile, the country that had orchestrated the Plaza Accord, the United States, had its own reckoning. The Plaza Accord did help reduce the US trade deficit temporarily, and American manufacturers got some relief. But it didn't solve America's underlying problems of productivity and competitiveness. And the lesson that currency manipulation could be used as an economic weapon was not lost on future policymakers. More importantly, watching Japan's bubble and crash should have taught American economists and regulators about the dangers of easy money and asset bubbles. But those lessons were seemingly forgotten when the US had its own housing bubble and financial crisis in 2008. Today, economists still debate whether the Plaza Accord directly caused Japan's lost decades, or whether Japanese policymakers made the crucial errors in how they responded to the currency appreciation. The truth is probably both. The Plaza Accord created an impossible situation for Japan. Their export-led model was suddenly unviable, and they had to restructure their entire economy quickly. The problem was that instead of allowing a painful but necessary recession and restructuring, Japanese authorities tried to prevent any pain at all through monetary stimulus. They replaced export-driven growth with debt-driven speculation, and when that bubble popped, the consequences were even worse than the recession they had tried to avoid. It's a lesson about the dangers of trying to manipulate complex economic systems and the unintended consequences that can follow even well-intentioned interventions. The 5 men who met at the Plaza Hotel in 1985 thought they were solving a trade dispute. They had no idea they were setting in motion events that would reshape the global economy and leave one of the world's great economic powers struggling for generations. And the most unsettling part, we're still living with the consequences today, and some economists warn that other countries, possibly including the United States or China, could face similar fates if they repeat Japan's mistakes.